Welcome, everyone. Good morning. Welcome to March. Hopefully, we're coming into the springtime, and everyone is starting to see the benefit of all of the progress we've made here in the coronavirus. We're almost a year into the pandemic, and hopefully, we're seeing some good signs as to whether we'll have a nice spring and summer that's more interactive. But in the meantime, we are presenting again another COVID-19 relief task force here at FML. We do have, as many of you know, my name is Frank Milone. I'm one of the founding partners, and I'm the co-chair of the COVID task force here at FML. We've established it about a year ago. Bill Claffey, who's presenting with me today, is my co-chair and has a lot of knowledge that we're going to share. FML is a full-service CPA firm headquartered in Glastonbury. We have offices in Enfield, Stamford, New Haven, and we've prided ourselves on being very responsive to the COVID-19 relief and all of the guidance that has come out in regards to stimulus and other aspects. And we're here today to talk about the employment retention credit and the fact that IRS Notice 2021-20 has come out. And knowing it's a busy time, we're going to jump right into it. I'll introduce my colleague, Bill Claffey, understanding that we're all busy, but we thought this was important, Bill, to get out. And want to turn it over to you, Bill, and let's work through the slide deck as we normally do.
Okay, great. Thanks. Appreciate it, Frank. For those of you that don't know me, Bill Claffey, I'm a partner at FML on the tax side. I tend to focus on some of the secondary issues that come after your federal compliance of state and local tax credits, policy and procedure, things of that nature. Also a member of the task force with Frank and a number of other members of our firm. Like Frank mentioned, we try to stay on top of that in terms of guidance, webinars, et cetera, getting information out to our clients and through the webinar clients and non-clients. So we've got a lot of stuff to cover here, Frank, and we're going to get into some weeds here, and we've got an hour. I tend to be a little bit long, so I know, Frank, you'll do your best to kind of keep me on track here, but just really wanted to, if you get 5 or 6 things out of this presentation, and like I said, we're going to get into the weeds. Just one, know that the employee retention credit's out there and that it goes through the end of second quarter, so through June 30th, 2021. Understanding that there's 2 ways to get it to be eligible for this. There's a revenue test, and then there's this government order test, which we're going to get into a lot of detail on. 3, understand that if you did receive a PPP loan, that there's interaction with the PPP loan that we're going to go through that you need to, understand as it relates to the employee retention credit and trying to maximize both incentives there. 4, how to claim the credit or in advance, and we'll talk about that. And then if you do have 2 more things, if you have a PEO, we're going to talk about additional steps that may be required. I've answered a lot of questions from some clients that had PEOs. How do I file it? How do I get information over my PEO? Am I eligible if I've got a PEO? Things of that nature. And then lastly, just understand that this is a credit, but there's going to be an income tax impact to your tax return, whether you're a pass-through entity or a C Corp. So those are kind of the 5 or 6 big picture items, and we're going to get into the weeds starting now. Okay, so first slide there. What I want to do is just kind of give a general history here. Just so you know, well, why are we even talking today, right? You've got the CARES Act that came out almost a year ago, and under that and pursuant to that, there was this kind of prohibition, if you will, that if you received a PPP loan, you couldn't take advantage of the employee retention credit, which is why it was pretty quiet from March all the way through basically the end of 2020. A lot of businesses that could have taken advantage of it just didn't. It wasn't available to them. During the spring and summer, kind of as it kind of came out in tranches, but the IRS issued a pretty detailed FAQ list, which went through a lot of different questions on qualified wages, eligibility, et cetera. Then you come into December 27th. We did a webinar on this on the Appropriations Act, and then within that, there's a number of different acts. So you've got the Taxpayer Certainty and Disaster Relief Act. Within that, they do a couple things. They repeal this PPP kind of prohibition on being able to take the employee retention credit, which was significant, but had this retroactive piece to it because companies, could have been eligible in 2020, but didn't claim it timely because of the PPP provision. They repeal that. They extend the credit to June 30, 2021. It was originally set to expire on December 31st. And then there's all these different changes in eligibility and calculations for the 2021 version of the employee retention credit, which should be very attractive to a lot of businesses in terms of the increase in the credit and the manner and revenue decline test in order for eligibility. As that was happening, the IRS in their FAQ, which anyone can go onto the IRS website and find, just Google it. They put a big banner on there saying that none of these FAQs were updated for the Appropriations Act and the Taxpayer Certainty and Disaster Relief Act, which, kind of made you take a step back and say, well, are these FAQs even valid anymore? March 2nd, March 3rd, the IRS issues this notice, which we're going to kind of get into some details today, 2021-20. It's a rehash of some of the FAQ, but it's in an IRS notice format versus an FAQ, which carries a little bit more weight. And also it answered some other questions, which we're going to get into that were not in the FAQ. One thing about that notice is it does specifically state, it's 102 pages long, but it specifically states that it's related to 2020 only. But as we'll see, there's a lot in there that I think is going to be valid guidance with respect to the 2021 credit. So I'm going to try and go through this quickly. I just want to get everyone on the same page. I've had, I being kind of deep in the weeds on this, you tend to forget, that other folks, haven't done all the reading that I've done, or haven't gone into some of the details, had the client conversations with all these various fact patterns. And you find out that sometimes there's not a connection in terms of what it is. And so I just want to really go through this quickly, a summary of what the 2020 version of this credit is, and then we'll go into the 2021 version and what changes were made. But
hey, Bill, just so you know, just so we're on the same page, when I'm thinking about this 2020, 21, 2021, they're not different. They're the same. They're just the process of claiming or the value of what you're trying to claim is different, right? Just give me kind of 2 seconds on that so people aren't confused.
Yeah, I mean, it's the same employee retention credit. It's the high level. It's the same 2 prongs to be eligible. Yep. It's a decline in revenue, and it's a government order, which causes a partial or full suspension. Yep. But there's 2 different, and then the calculation of the credit, which is based on paying qualified wages to employees, is different. The 2020 version, as is in the bullet right down there, is it's 50%. Yep. 2021, we go up to 70% of the $10,000 of wages. So yes, it's the same credit, but
we've got a good slide here, Bill, that's going to summarize the differences right between the two, the 2020 and the 2021, coming up in a bit. I just want people to get an understanding, for those of us that aren't as in the weeds as you are. Yeah. It is pretty much the same, but it's different in the fact of how they're calculating, how you qualify for it, and it gets confusing. But I think as we go through this, you'll see most of it is trending and has very similar concepts that are running through both 2020 and 2021.
Yeah, similar concepts. The legislative intent was to extend the credit, and who knows whether that'll be extended further beyond June 30th. Yep. But also it just wanted to open up the eligibility. Yeah, more people, and increase the value of it. That's basically what they tried to do.
Understood.
Yep. So anyway, so the credit gets applied against your Social Security tax for the employer, right? So that's half the Social Security tax. Excess credit is refundable. So that's really the big kind of carrot, the big nugget here. That's why it's so attractive, is that if you're getting a credit and your employer portion of your Social Security taxes is $10,000, but you have a $50,000 credit, you can get a $40,000 refund on the excess. The credit is treated as overpayment, so it's not income, right? So that's pretty critical, although we're going to see that there's a deduction issue. Okay, so high level, right? So the credit itself, it's 50% of qualified wages paid by an eligible employer to an employee during an eligible calendar quarter. So that means, and the 2020 version of this credit is those wages paid between March 12th and December 30th of 2020, capped at $10,000. So you have to be an eligible employer, and we'll get into that what that is, and you have to make payment of qualified wages during an eligible quarter. if all of your quarters in 2020 are eligible and you pay an employee $100,000, that qualified wage gets capped at 10, and the credit is 50% of that amount, so it's a $5,000 credit. So kind of think of it in those terms, right? Basically, if you have eligible quarters, if you're paying employees, more than $40,000 a year, you're probably going to get $5,000 per employee as an employment tax credit as it relates to 2020, because it's that whole payment cycle, March 12th to December 31st. Eligible employer, eligible quarter, right? So there's two ways to become an eligible employer. So this is right. This language that I put in quotes is right from the statute, right? So this is the full or partial suspension. So there's two prongs to be eligible for this. One is a decline in revenue, and then two is this full or partial suspension. We'll talk about that first. So the operation, trade, or business is fully or partially suspended during a calendar quarter due to orders from an appropriate governmental authority limiting commerce, trade, travel, or group meetings due to COVID-19. And that's it. What you see right there, that's what it is. That's the only language that's in the statute. The IRS then in their FAQ and in this notice turns that into 102 pages of guidance.
Yeah, so we'll get to that though, right, Bill?
Yep.
So we're gonna deep dive into that last bullet a little bit more as we go forward, right?
And just one important point on that last slide is that in order to be eligible for that prong, you're looking at a government order. When did it start, and then when was it lifted? Because you really have to track those. It's challenging. We have to track those, right? If you had a government order that was issued on March 12th, but then was lifted on March 30th, well, that's your eligible time frame for purposes of this part of the test.
So, Bill, when you say capped at 10,000, for those of us who are less inclined to understand, is that 10,000 of value that I'm getting on a per quarter basis? Is it per the total value that I can get for the period 3/12 through 12/31, or what is it?
Think of it like this. You've got, just try and take a very simple example. You've got an eligible time frame. There's in this example, the partial suspension, right? So you've got a suspension you've got a government order that has a full or partial suspension to your business. That order is issued on March 15th, and then the order is lifted on October 1st.
Mm-hmm.
Okay, so that's kind of like that's your time frame.
Period. Yep.
Yeah, that's kind of if you're going under this piece of the test. And so you're looking to see, well, who did I pay qualified wages to? Well, qualified wages are just wages you're paying to your employees. If you paid employee A $60,000 during that time frame, your credit is 50% of the qualified wages, 60,000, but only up to 10,000, right? So you're only
one employee.
For that one employee.
Okay.
Then you've got a second employee. You hired that employee in, let's say September 1st, and you paid that employee $7,000 during this eligible time frame. Well, you're only going to get a credit of $3,500 because it's 50% of the qualified wages paid during an eligible time frame, eligible quarter.
So and that cap is on a per employee basis. It's not
cap is on
it's not cap on the entire period. So during that period, I can get a maximum of $10,000 per qualified employee based on the qualified wages.
$5,000, right? So
$5,000. Sorry.
The cap is on the qualified wages, and then it's 50% of the qualified wages paid.
All right.
Okay. That's prong one. Prong two, significant decline in gross receipts, and this is the much easier one. If you had, unfortunately, if you had a decline in receipts, obviously nobody wants that, but if you had it, this is an easier way, a much more kind of understandable way, and a much more objective way to get into this employee retention credit. So that decline in gross receipts is a 50%, and you're always comparing quarter over quarter, right? So you're looking at quarter one can be an eligible quarter because it started on March 12th, right? So you've got 19 days in March for Q1. But you're looking at over 50% decline relative to the same quarter in 2019. So you're looking at Q1. Did I have a 50% decline in gross receipts? And gross receipts is basically the same. If you are a cash basis taxpayer, then you're going to be on a cash basis. This is all unlike the PPP where you've got the SBA and you've got the IRS and you've got all these various bodies. This is all kind of housed within the Internal Revenue Code and the Internal Revenue Service. So, cash to cash, accrual to accrual if you're an accrual basis taxpayer, but that's the way you're going to compute your receipts. and you're looking for a 50% decline, because that starts the clock ticking, right? So let's say you look at, and Q2 just happened to be kind of a very common time frame, because that's when we're really kind of we're feeling the impact of the pandemic, right? Companies were transitioning; they were trying to figure out how, a lot of folks were kind of shutting down to some degree, and you look at your receipts in Q2 of 2020, and those receipts were $400,000, but your receipts for Q1 in 2019 were $1 million. Well, I've got more than a 50%. I've got more than a 50% decline. So my Q2 is eligible. That's your starting point. And and again, I quoted some language here, and folks can read it. It's really hard to. I had to read it many times, but basically what that says is it ends with the first day of the next quarter, after you have a quarter where your dip is less than 20%, right? So if you're eligible in Q2, you had a 60% reduction in gross receipts. You turn things around Q3. Let's say your reduction Q3 2020 to Q3 of 2019 is only a 10% dip. Well, you would think, well, that might not be an eligible quarter, but you carry that eligibility until the end of the
Q3?
end of the quarter in which you had less than a 20%. So they're kind of shifting the percentage from 50 to 20%. So you automatically kind of get Q3 as an eligible quarter. So now you've got basically 6 months of activity where you can claim this credit on qualified wages.
Yeah, no, this is super important. Couple things people need to understand is that cash basis, if you're a cash basis taxpayer, accrual basis, if you're an accrual basis taxpayer, and the concepts of when to start and stop the calculation period, right? I think we need to keep moving though, because I think there's some questions coming up about the new 21 guidance, but I think this is super important for people to get that baseline knowledge, right?
Yeah, well, it's really important because 2020 is, you have 3 years to claim this credit. So folks that didn't claim the 2020 version of it, they can claim it on their amended 941, which we'll talk about, but they can do that anytime from now for the next 3 years.
And it's super important to understand that too, because I think a lot of people are thinking, Bill, that there's a time pressure here, right? To do this, I need to do this right now. And if I don't do it, well, maybe I don't have the time to figure it out, or maybe I'm confused and I can't get access to an expert like FML. I'm not going to really get to this until the summer or till the fall of 21. You've got plenty of time to figure it out. And there's value here that it's worth your effort to go through to figure out if you've got opportunity to take advantage of this.
Yeah, you've got time to figure it out. There's an income tax return impact here, which we're going to talk about, which you can always go back and amend a return, but March 15th. That's why I wanted to get this out before the 15th. But
yep,
is a looming deadline, and so we'll talk about that. For the 2020 version of the credit, this is really critical, and it's a change that was made for the 2021, which we'll talk about. But there's basically two employers. You've got a large employer. That means you had greater than 100 FTEs in 2019. And if you are a large employer, and so what's an FTE? Well, we've got all these definitions, right? Everyone's probably like, well, when I applied for my PPP loan, it was just number of employees. Then when I had to do my reduction quotient, it was an FTE for PPP, which was measured at 40 hours a week. And now you've got the ERC, and now you're telling me FTE. Well, the FTE for purposes of this everything's housed within the Internal Revenue Code. This is a 30-hour a week test, right? So if you've got someone that works 31 hours a week, on average over 2019, that's an FTE.
So that's critical. Another critical point, Bill. I'm going to point them out, right? 30 hours for your FTE calculations. Most people are getting totally confused. We deal with this every day, right?
Yep.
Because most people are getting definitions of FTEs through the PPP concepts and some of the other CARES Act concepts, right?
Yep, absolutely. And again, and I understand. It's, I've gone through it many times, and I still kind of find myself like, which concept we're using here. But hey, can you just go back to that slide? This is really critical. If you have greater than 100 FTEs, you're considered a large. This is the 2020 version. We're going to get into how this changed. But you're considered a large employer. Everything we just talked about in terms of taking qualified wages. If you're a large employer on the 2020 version of the credit with over 100 FTEs in 2019, You can only claim credits for wages you pay to employees that are not performing services. And that's critical. So you'd have to, if you had 150 employees, you're going to have to take a look and say, well, I kept everybody on. They all continued to work, a 40-hour work week, but I reduced their pay by 25%. You can take credit on the 25% kind of, the 25% that you paid them not to perform services. Or I had, 17 people of my 150 employees that I kept on board, but they were unable to perform services because of whatever reason, right?
So paying them to stay on, but they're not really doing what they're normally doing because there's nothing to do.
There's nothing to do, correct. If you are a small employer, so that's 100 employees or less, the whole game changes, right? If you're a small employer, you take this credit on all employees, regardless of whether they are performing services or not.
That's right. So you meet the test, everything's included at that point. If you meet the test, large employees, you're only getting the credit for certain employees that are either not providing services or have been reduced to a point on wage-wise that they're not getting paid for the services, right?
Yep. Right. So if I have 90 employees, I've got eligible quarters and everything else kind of fits, I've got an opportunity to get $450,000 of employee retention credits, which are fully refundable. Yeah. If I've got 105 employees, I may only get credit on 5 of those employees, or I may only get credit on 15% of the wages that I reduced people's pay, but still required them to work 40 hours. Yep. So it's pretty significant. Okay, so just some concepts here on qualified wages. Basically, your wages that you're paying to employees, if you and any kind of other compensation and I put in the Internal Revenue Code references here, but it's basically your wages and compensation. It includes health plan expenses. So if the employer is paying, health benefits, that's also includable as qualified wages. If you took advantage of the Family First Coronavirus Response Act credits, so that's for like family medical leave and sick pay, you would have gotten a dollar for dollar credit on those payments. That's not an eligible cost, right? They're not going to allow you to kind of triple up the benefit on that.
Bill, yeah. And just because there's a lot of time, some of this is for those of us who maybe aren't as familiar with some of the IRS references in the Internal Revenue Code. This is some of this gets complex. You're going to have to work with your advisor to kind of understand what exactly is or is not included within the qualified wages, and then also making sure you've got these other provisions understood so that you're not misunderstanding what you can and can't do within the group, right?
Yeah, it's a pretty. I mean, in some respects it can be straightforward, but in a lot of respects there's a lot of spider webs here, and you can get kind of turned around pretty easily and either not take the maximum benefit, or you get into a situation where you're claiming more benefit than you received, and then you subject yourself to penalties and interest and so forth. Can you just go back to one quick second? I know you're trying to keep me on track here, but just these other provisions, these are kind of important. There's aggregation rules. Everybody's treated as a single employer, right? So you can't, if you have a consolidated group of entities, and you've got 50 employees in one and 75 in another and 25 in another, that's not 3 small employers. That's one big employer. Okay, so pretty important for that if you have that entity structure. Expense add back, we'll talk about that. That's the income tax impact, and no double. If you're taking WOTC credits, no double benefit. You can't take and then employer leave credits. Okay, we can go to the next slide, Frank. Okay, in a nutshell, that was the 2020 version of it. Then we get the Relief Act, December 27th, 2020. And we get these pretty significant shifts. The core of the credit stays the same, but there's a lot of shifts here. So, the first point we mentioned, if you had a PPP loan, you can now claim the ERC not only for 2021, but you can go back and claim it for 2020. You just can't double dip on the wages. So that it is, and we're going to get talking to some other concepts that came out as part of this notice. But you really have to kind of keep almost like 2 parallel spreadsheets as to PPP, payroll.
We're going to get into some of this detail, Bill, right? I mean, in this, I think some of the examples play this out pretty well on how maybe if you haven't done your forgiveness calculation yet for your PPP, initially people were like, listen, let's just do payroll to make it easy and move on. I think now if you're eligible for the ERC, you want to maximize your non-payroll to make sure you're not getting cut out of the ERC. I mean, that's what I saw, Bill.
Yeah, no, and that's 100% true, and to some degree very unfair. Companies that, for all you that filed your PPP loan and got your forgiveness, great. But if you're eligible for the employee retention credit, the fact that you got your PPP loan in, which was understandable, that this law had not been passed yet, and many folks had already submitted their forgiveness, you could be penalized for purposes of the employee retention credit because of some positions the IRS is taking on that. So we'll get that. Okay, so extended the ERC, we talked about that. You got Q1 and Q2 now eligible. Increased the credit rate to 70%, and that's in the new ERC, called the 2021 version. It's not 70% of qualified wages for that whole period. It's 70% of qualified wages with a $10,000 cap, but per quarter. So whereas in 2020, if you had qualified wages paid to employee X, your max credit on wages paid to employee X would have been $5,000. If you're eligible in Q1 and Q2, those same wages paid to, or those wages paid to employee X, assuming they're more than $10,000 per quarter, you're potentially going to get a credit of $14,000 from the wages paid to employee X, because it's 70% of $10,000 per quarter, not over the lifespan of that whole period. Next bullet, increase the threshold large employer. So we talked about the critical nature of that large employer, small employer designation. It brings it up to 500. So now, you've got 150 employees, you're a small employer. Now you're getting credits for everybody that you're paying.
Yep.
Reduce the gross receipts test. So we talked about how in 2020 you had to have that one quarter that was 50%. It reduced that to basically to a 20% reduction.
So again, we're getting a little bit, we're crossing over. 20% now is your reduction that qualifies you, not the reduction that stops your qualification quarter at that point, right?
Correct. Yep. Right. And then next bullet, safe harbor. It allows businesses to use the prior quarter to compare gross receipts. So, and why did they allow that? Why did they allow that to happen? Well, this whole intent was to get money into businesses' hands, so that they could keep paying payroll. So what they did is, as they extended the credit, they said, well, we're going to allow you to use quarter four, compare Q4 2020 to Q4 2019. And I know it says 80 there, but it depends on which way you look at it, but it's a 20% reduction.
Yep.
And if you meet the test for Q4, then you meet it for Q1. And so you can go get an advance on the credit if that's the way you want to handle it. So that you've got that option as well. Okay, and then allow small business to take an advance of the credit. And so that's basically saying, I am anticipating getting a credit because I met the test in Q4, let's say. I'm anticipating getting the credit for Q1. I'd like to get an advance on that credit. You file, it's a one-pager that gets faxed to the IRS, if anyone still has a fax machine. And then they will pay you the amount that you request, and then you reconcile it on your 941. So here's a chart that just has the key changes, right? And we kind of went through all this, but this is basically kind of in one big nutshell. Hey,
Bill, when you say prior quarter measurement, and I'm going to keep moving here, but that's any prior quarter? I mean, so like you mentioned Q4 to Q1, so does that mean you can measure it from Q1 of 21 to Q2 of 21?
No, you can use the prior quarter as your measurement period, meaning the immediate prior quarter. So if you're trying to look for eligibility in Q1, you have to use you can either use Q1 or you can use Q4 to Q4. You can't kind of mix and match there.
Understood.
Okay. Okay. Now we get into the IRS. Okay, we're 34 minutes in. We're getting into the notice, but you got here's the key topics. It really gets into some details on this full or partial suspension, which is kind of the second prong for those of you that might not have met the gross receipts reduction test. And I'll just say this, I'm going to make a point about that. That is an area that it is very facts and circumstances oriented. There are the number of boutiques out there that are, I would say are being fairly aggressive in terms of that piece of the test. not saying it's right. I'm not saying it's wrong. I'm just saying that it's out there. And I think understanding as we go through this, I don't meet the gross receipt. If you meet the gross receipts test, great. Go with that one. But if you don't meet it, you don't want to overlook some very lucrative benefits here because you didn't want to look at the government order test, the full or partial suspension. Interaction with the PPP, this is critical. We'll go through that. Claiming the employee retention credit, income and deductions, which we've touched on, and then PEO. So we'll get into the weeds on each of these topics.
Yeah, Bill, we talked about, there are some specialty firms that are going out there and making huge promises. And one of the things that we've talked about internally is trying to maximize your ability to take advantage of this ERC is critical. But obviously, you need to make sure that it's supportable too. And what we're just telling our clients as we go through this is, obviously, anybody that we deal with knows that we have their best interest in mind, and we're going to do our best to make sure that they get as much that they're qualified for. But taking certain positions, this is things we deal with every day, right, Bill? We're audit and tax advisors. You take positions that are supportable and also able to maximize the value to your clients. And you should just make sure that you're working with advisors that you can trust in that regard, that you want to make sure that whatever you're getting credit for is not going to be something that you're unable to defend on a go-forward basis. So
absolutely. And you'll see this one gets a little bit, like I said, it's very fact circumstance. If we go back to the definition that's in the CARES Act, right, which is the CARES Act is many, 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 many pages, but the full or partial suspension is one paragraph. The operation of the trade or business is fully or partially suspended during a calendar quarter due to orders from an appropriate governmental authority limiting commerce, and this is key, limiting commerce, travel, or group meetings due to COVID-19. So that's what this whole IRS notice gets into. It was addressed in some of the FAQs, but now it's in notice format and some variances as well. Okay, so what is a government order, right? It's orders, proclamations, or decrees from a federal, state, or local. This could go all the way down to the mayor of your city issued something that limit commerce, travel, or group meetings and relate to a suspension of the employer's trade or business. Okay, so you're looking for things coming from the CDC, OSHA, things coming from the governor of your state. You're looking for, like I said, even down to the mayoral level.
So Bill, let me ask a question. You said statements. No.
Okay. Well,
what does that mean?
Okay, so statements. Any kind of let's say the governor gets on your local news and he makes a statement about COVID, expressing the necessity to keep social distant, to be socially distant. That's not a government order. That's a statement. It's a statement, right? But it's not a government order. This has to come through like an official decree, right? And you can find there is about 26 pages of government orders in summary format, just listed, that are coming from the state of Connecticut, either from Governor Lamont, coming from the Department of Health, or coming from some other agencies within the state of Connecticut. The same holds true for the state of New York.
Bill, in the interest of time, what we're saying in this is, listen, this is pretty much black and white. You can't, you have to make sure it's a qualified government order to ensure that you're trying to meet this test, trying to meet this qualification. You have to basically, what this slide is trying to tell me is, if it's a declaration of emergency, you have to make sure it meets certain other criteria. Any sort of statement that's not issued in a qualified order, you can't make it work. You have to, it's either a yes, no answer here.
Exactly. I mean, it's a yes or no answer as to whether it's a government order. Then, the tricky part comes into, well, did it suspend my business? Because that's where the kind of teeth of this is. But so the examples there, those are great from the notice. Those are very specific examples they give on qualified orders. It's not an exhaustive list. It's just some examples. Okay, full or partial suspension requires an order that has more than a nominal impact on business, and this more than nominal impact is like flooded throughout this notice, right? It's all over the place.
Hey, Bill, for someone who is not in the details, when I was reviewing the slides and going back and forth with you, this is where the rubber hits the road, in my opinion. right? This is where the judgment now becomes critical, right?
Yep.
This is how you're going to now work with an advisor to make sure that if you have the first slide that we just went through, right? Now it's a matter of, can I ensure that it meets the definition of a full or partial suspension, right? My impact individually.
Yep, exactly. And so they put a 10% test on that. So it's like you could have all the orders in the world, but if it doesn't have a 10% impact on your business, then it's not more than nominal. And that's now, and so you can look at that by, testing gross receipts. Now that's difficult. There's no objective. It's not like, putting together the PPP calculation.
Yep.
You got to take a look at your business and say, okay, this order had this impact on my business, which was more than 10% of my business, either through, the hours of service or the gross receipts. It's interesting. I don't know how the IRS will audit that. I just know that if they do, me personally, I want to be prepared.
Yep.
Okay. So then they give some examples here. So it gets a little tricky here, but like they give an order, they talk about suppliers, right? So if a government order didn't impact your business, but didn't directly impact your business, but impacted your supplier, and they were providing you with critical goods and materials, then you're considered to have a government order that fully or partially suspends your business. And if you are, now that bullet there, they say that you must exhaust alternative suppliers. So basically they're saying, okay, well, you can't, if your supplier is based in, New York City and an order kind of shut them down, but you could have just gone to a supplier in
Texas,
Hartford, or in Texas, or wherever. Texas is good. Mississippi, Florida. Then that government, then you're not considered to have a full or partial.
So again, Bill, I think my auditor hat comes on here, right? So you're going to have to be able to demonstrate that you went to the 3 quote unquote qualified suppliers in your business supply chain, and it was shut down.
I don't know that it doesn't. I don't know that it says it that directly, but I think that you would probably have to do some diligence, right? Mm-hmm. And then you'd have to demonstrate that if you got audited. But again, it's very facts and circumstances. But that example's right there in the notice. Customers, this is interesting. A government order requiring your customers to stay at home is not a full or partial suspension. They basically say, well, you can still get in through the gross receipts test. And they talk about an auto repair shop, and the example is you're an auto repair shop in City X, and your mayor has issued a stay-at-home order whereby customers can't go out, or folks can't go out unless they're going to the grocery store or to a doctor's appointment. So you basically can't, you don't have any customers, and they basically say that is not a government order requiring your shutdown, and it's not. And so that's come up in a couple different conversations I've had with some clients of, our customer base was kind of, choked off.
So Bill, you can really, the logic would dictate that my gross revenue test is going to cover me in this scenario, because I'm not going to have customers come, because most customers are going to comply with the order. But you can have something that basically does this, but you just don't have enough revenue decline, so you may be out of luck, right? You may not hit that gross receipts test, but there's an order that you're saying, well, listen, my routine customer just got told he or she can't come to my business. Well, you must have had enough people show up or have another line of business that supplemented that in a way that you're now not able to take advantage of a full or partial suspension.
Correct. Yeah, correct. This is an interesting example. It was in the original FAQ that was put out in the spring. I thought once it got to this stage, or once they revised the FAQs, or eventually got to this notice, they would have pulled it out, because those are orders that do restrict commerce, and you can even make an argument that they restricted travel. Maybe I guess the position the IRS taken didn't impact your travel as you as the business owner, so therefore it's not a government order. But there's a lot of gray here, Frank, and I'm just trying to report what's in the notice. But these are the kind of things you're gonna have to talk through with your advisor. I mean, like I said, there's a lot of money on the table. What was that last one? Oh,
it was voluntary, Bill. Sorry.
Yeah. So any kind of if you're a business and you say, hey, we're gonna shut down, because, you know, the safety of our employees, that's not a full or partial suspension.
Well, Bill, I mean, that's kind of like, you know, our example, right? Out of the abundance of caution, you know, quote unquote, we were a essential business, CPA firm. But we decided to go full remote. We couldn't use our voluntary full remote as some sort of a trigger.
Correct.
For us to try to a full or partial suspension, right? I know I'm making it easy, but that's basically what that means.
That's basically what that means. Yep. And you'll see as we go through this. I mean, and this is very typical of any kind of governmental agency, right?
So Bill, the 10% test.
Yep.
Someone just asked a question, 10% entity wide, or can it be one program of an organization?
No, it's entity wide. Everyone's considered a single employer. So
Okay.
Whether it's consolidated entities or whether it's a single entity, you can't look at one program, you can't look at one revenue cycle and say this was shut down there, or this was, if that only represented, and the example we're going to get to is if you are let's say you're a restaurant and you've got takeout service and you've got dining service and you've got you've got a bar, right? I mean, if the order only shut down your one portion of your business, but it wasn't more than 10% of your total business,
right? Then
it's not a full or partial suspension.
Understood.
Okay.
Makes sense.
Telework. Okay. So you could have a full suspension. Based on this first bullet, you could have an order that could have caused a full or partial suspension. But if you can telework in a manner that's comparable to your operations prior to that, then the IRS is basically coming in saying that's not a full or partial suspension. Yeah, it's a government order, and it could have been. And so there you really get into some facts and circumstances that are going to be dependent upon your business and how you operate, how you operated prior to the pandemic.
Yeah, I found this one to be really gray, Bill. You know, in that software company example there, you know, so some operations can continue to work telework, but some of them can't. Right now, you're making second, third level decisions within this process, right?
Right. What you're going to look toward, and so you're right. It's perfect. There's a lot of gray here, Frank. I mean, I don't know how the IRS is going to audit this. I mean, nobody does. If they say that they do, they're wrong because it just hasn't been audited yet. But that software company, they were able to work remotely. They did work remotely. That's probably a fact that they would potentially look at prior to the pandemic, and so they really didn't have a big hit to their business.
So that last bullet on this page, Bill, that's what we just talked about, right? You got to look at the business as a whole, right?
You got to look at the business as a whole, single employer. Yep. And then just real quick on that physical therapy, because this came up in a client call that I had. They give an example of a physical therapy company who migrated over toward virtual appointments.
Kind of like a teledoc thing, Bill?
Yeah, kind of like a teledoc thing. But in the example, they basically say, but because physical therapy requires the use of specific equipment that they don't have access to with their clients, that would be considered a partial suspension or a full suspension. And then same with the lab research. They say, if you've got a company that's got a laboratory research, and they've got some folks can work from home, but some folks can't in the lab environment. And the lab is more than a nominal portion of your business, then if the order that would shut down the laboratory would be considered a partial suspension.
Hey, so Bill, we got a good question. Government limits of gatherings as they affected house of worships, would they qualify? My gut is yes, but the government order. So if Lamont is basically limiting inside gatherings to a certain amount,
yep,
and the house of worship is unable to continue to, I guess, hold those events, right? That would be something that is a government order, right?
Yeah. I mean, I think that the kind of the obvious companies that fall into this are houses of worship, I guess. But restaurants and gyms and things of that nature that really had like the real direct
banquet halls.
Yeah, I mean things that that are, I don't want to say fairly obvious, but there was a government order that absolutely shut down their ability to to operate their business at its capacity. And so, and keep in mind, this is a for-profit or a non-for-profit, right? It goes against the employment taxes. So whether you're for-profit or non-profit, you could be eligible for this. So
want to keep moving here, Bill?
Yeah, let's keep going. Yeah, keep moving. Just quick point on the multi-state. You don't have to go back, but multi-state. This is interesting. It kind of opens up, if you have a multi-state business, you could, if you had an impact in New York on an order, or an impact in San Francisco, where there, if you have a full or partial suspension to that piece of the business, your whole business is considered partially or fully.
It's consistent on the consolidated, concept, right? So if one aspect in one state, yes, then everybody, now you're in the qualification concept, right?
Yep. Yeah. So this next slide goes through some of the factors that they are going to use to analyze that, right? So this goes into the things you were mentioning, Frank. Telework capabilities, right? What's your IT network look like? What's the support? How portable is the employee's work, right? For an accounting firm, probably pretty portable, right?
Yep.
I mean, for other industries, the physical therapy company, not so much. Yep. Need for, and these are all factors, right? I'm not saying you can't get it if you're in the accounting industry, but you'd have to kind of put together this big set of facts to make sure you understand your eligibility. Is your presence at employees' workplace, is it, the three factors, critical and necessary? Is it beneficial but not necessary, merely convenient? I mean, I could argue that for an accounting firm or a law firm or firms of that nature, IT firm, where do you fit on that? Do you fit?
Bill, the more I dive into this with you, Bill, I think about the old, the PPP eligibility criteria, right? That high level look where the guidance was like, listen, you still need to, you need to be able to support that you really were eligible for this. Like you needed it. You didn't have access to other capital. You didn't, you know what I'm saying, Bill? And they started throwing some grayness in there. Yep. Because what they're trying to make sure people aren't looking to do is, right, and this is my guess, right, Bill, is, hey, I hit it, so let's just take it. Whether I really, and when you step back and look at it, where I've really dealt with a partial suspension, yep. FML, let's talk about it really quick. We moved full remote a year ago, right? 95% of our employees are working remote. Even if we weren't ineligible, or a essential business, right? My point being is our telework capabilities, clearly we were not suspended. We had people doing work from day 2 of remote. It's those logical thought processes I think need to, I guess, work through your analysis here, right?
Yep. Yeah, absolutely. I mean, right. And so there's the factors that I'm not going to go through each one of these examples, but just let me see one that's.
I'm sorry, Bill.
The grocery store one was pretty interesting, right? So if you're a grocery store and you have a self-serve salad bar, and there's a government order that says you can't have a self-serve salad bar, basically the IRS goes through and they say, well, that's not a full or partial suspension because it doesn't have a nominal impact, and they just looked at the gross receipts. What are your gross receipts from the salad bar? What are your gross receipts from? Now, they didn't do this, but this is what's in the example. And what are your gross receipts from all the other groceries you sell, right? And so if that was only a 5% impact, then they say, well, that's not a full or partial suspension. And then the retail store and curbside pickup, they basically look at that and they say, okay, if you were shut down, you couldn't open up your Dick's Sporting Goods, for example, then you've got a partial suspension. But let's say that some of those orders start getting lifted, right? So it went from you couldn't have any business. Then you could only have curbside. Well, what is the curbside versus retail? Is that more than nominal? Yes, it was. Then you could start allowing customers to come in the door, but you could only have 100 customers at a time. They actually, in the examples, they actually go into the level of detail of saying, well, if you could only have 100 customers in the store at a time, how did that impact your business? Well, if you're Dick's Sporting Goods, it's a big store, right? Staples, all these big, retail stores. In the example, it says if it only causes a short wait time in line, then you don't have a full or partial suspension during that time frame. You had it when retail was closed. You had it when it was curbside only. But then when it was you could have 100 occupants. Whereas if you had a much smaller store and you had to have I guess what you take out of it is if people had to wait 2 hours outside to get into your store, Apple store maybe, they might have had that kind of situation. Now they probably, yeah, then potentially you are eligible for this. It really gets into a minutia of detail that's, God, you just got to take your facts and try and plug them in and see where you come out. We can kind of go through this. I know we're running late on time here, but the last point there, I just put in Hub because I was just kind of like, well, what are they doing here? They have some language in there that says it talks about government orders that cover a partial quarter, right? So you've got an order that's from March 12th to April 20th, right? Covers part of quarter two and part of quarter one and part of quarter two. And this is the exact language. An employer with business operations that are fully or partially suspended during a portion of the quarter is considered an eligible employer for the entire quarter. Great. However, only wages paid during the period of suspension are qualified wages. I don't know, unless I'm losing my mind, that says two the exact opposite things.
So basically you can take both quarters, but you can only take the 15 days in quarter one and the 15 days in quarter two of eligible wages. That's what it's saying, qualified wages?
Yeah, I guess you could read it that way, and that's probably the right way to read it. And I'm just too deep into it to see that. But yeah, I think that's the way it is.
It's my role, Bill. Clarity.
Okay, decline in gross receipts. We talked about this 448C. You've got all the definitions of what are gross receipts of note for-profit businesses. If you sell an asset, again, you're comparing 19 to 20. And just one point on the full or partial suspension. Just remember that if you meet this decline in gross receipts, all of that other stuff is irrelevant. Everything we just talked about with full or partial suspension, don't even think about it. If you meet this gross receipts test, then you're eligible.
I think most of the time, Bill, communications that we're having, or people are doing the gross receipts test, but they're maybe not thinking about the second test if they don't qualify for gross receipts. Right. Yep. So I think part of the main message here that I'm giving my clients and what we're giving the people that are participating is, listen, it's more complicated. There's a lot more gray to figure out, but it may benefit you to go into the partial suspension concepts, full or partial suspension, because it will bring you right back to the value that you would have gotten if you qualified under the gross receipts test.
Yep. So just a couple quick points. If you're a for-profit business, it's your gross receipts. If you sell an asset, you adjust that for basis, so you're not taking the proceeds on the sale, you're taking the gain. And then PPP forgiveness is not considered a receipt.
Yeah, some of this I found interesting, like for my world, right? Interest, dividends, rents, interest, dividends, capital gain. That stuff's not necessarily defined as gross receipts in our world, but again, we're dealing with tax concepts here, right, Bill? We're dealing with the tax concepts are driving this through. So when you get a non-tax individual like myself looking at some of this stuff, it seems a little bit clunky, I guess is the word I'd use. So
yeah, I mean it is, and again, it's also inconsistent with what the PPP was, and so it gets challenging to keep everything straight.
So Bill, good question here. So if someone qualifies under the decline in gross receipts test for Q1, are they automatically qualified for Q2, or do they have to go through in 21? Do they have to do the test again in Q2?
Well, it's a great question. Under the statute, right, under the original CARES Act, and there's nothing in the Appropriations Act that changes that language that I saw, although reading the Appropriations Act is a not fun task because everything reverts you back to the CARES Act. But I didn't see anything in there that changed that. And under the CARES Act, once you had an eligible quarter for the receipts test, remember that it automatically carries you to the next quarter because you get to the end of that quarter until your receipts dip below 20%.
So the answer there is, if you qualify in Q1, the ending of the ERC is June 30th. So you're automatically getting into Q2 because of the next measurement would be in Q2, right? And then you would go that 20% decline test, Bill, right? But you only have 6 months in 21 to deal with it anyway. So you're going to get it for both quarters.
Correct. The key, and maybe this is what the question was aiming at, is if you're using the safe harbor. I don't know that question's been fully answered because you're using the prior quarter to get eligibility.
I understand your question. So if you're going back to Q4 of 2020 using that safe harbor, do you automatically qualify, or do you have to test again? That's a great question.
Yeah. So I don't know that that's been fully answered yet. I imagine that's going to become, kind of utmost importance as the IRS is kind of getting through getting into
Yep.
Q2.
Yep.
Okay, so acquisitions, apples to apples. If you had an acquisition in 2020, you're including those receipts in your 2020 receipts. Go back and put them into your 2019 receipts for the acquired for the target. Safe harbor measurement, we just mentioned that. Yep, keep going, Frank. Qualified wages, we talked about this.
Yep. I think
we talked about that. People can look at that on the slide. Okay, PPP interaction. This is pretty critical. So this applies for round 1 and round 2. If you got a round 2 loan, you can take the employment tax credit, which we talked about. Can't take it on the same costs. Under the Relief Act, so that's our December Act. It basically what it does, it defaults wages, qualified wages, defaults them to the employer retention credit, unless you make an election to have them directed towards the PPP. So when I've been talking to clients, I'm like, think of it as like 2 spigots, right? You've got wages going to ERC, wages going to PPP, and what you want to do is you want to direct them one way or the other, so you're maximizing both benefits if they're both eligible.
Yeah, the example, Bill, I think we're coming up to an hour, and if people want to stay on, they know us well enough to know that we're both long-winded, Bill, so we'll just keep going, right? But the examples, and we'll get the slides out to people, we'll get we'll get a link to the webinar out. They help clarify some of these complex concepts, Bill, right? But let's keep going. But I do think the examples here do help people understand what you mean here by the spigot concept, right?
Yep. And so that election, just go back real quick, Frank. That election is the election to put it on to include it in the PPP is, there's no form you submit. It's basically the election is made by not including the qualified wages on your 941 and claiming the ERC. A backwards concept. I mean, yeah. From my perspective, but that's the way you do it. And then when you talk about 2020, now we're going to get into some other issues. So that last bullet is, but I already submitted my forgiveness application. I didn't have the opportunity to make this election, not make this election, and so forth. So let's go to the next slide, Frank. So they go through some examples, right? So what they say is that for 2020, and this is what I said in the beginning, if you already submitted your forgiveness app, unfortunately, under this notice, you may be kind of potentially in a bad spot. Is that they're going to deem that you made the election to turn the PPP spigot on and send it towards PPP if you already submitted your forgiveness application. And so, very simple examples here. You had and this was kind of relevant for most folks that took the 24-week option. You had a $100,000 PPP loan. You talked to your advisor at the time. It made sense. Put all your payroll onto the thing. Don't claim any rent or utilities. It's just gonna make everything more difficult. You put $200,000 of payroll on your loan application. It goes through. You get forgiveness from the SBA. Well, what they're saying here is they're deeming, they're not for the whole value, not for the whole $200,000, but up to the amount of the loan. They're saying, well, $100,000 of that payroll is not eligible for the employee retention credit. So if you were eligible in Q2 and had a time frame where you had $100,000 of employee retention credit qualified wages, but that was also on a PPP covered period, well, guess what? You're out of luck. You don't get the employee retention credit. Example 2. Same 100,000, 200,000 of payroll cost claim. So here, that's a little different between example 1. You had $40,000 in non-payroll. So remember, for PPP, you could, up to 40% non-payroll could be included. You got $40,000 non-payroll, but again, you didn't claim it. You didn't.
When you say not claimed, Bill, it's not on your forgiveness application.
You didn't put on. So in the first example, you didn't have any rent. You didn't have any utilities, let's just say.
Yep.
Second example, you had all that stuff. You had $40,000 of those costs, but you didn't put it on your PPP forgiveness application.
Because you didn't need it.
Because you didn't need it, right? And no,
and you're still
very few would have ever told you to put it on there because it just was complicating matters.
Yep.
Same conclusion, $100,000 payroll cost not eligible for the employee retention credit. Again, you need to match, as you go through this, you're going to need to create parallel spreadsheets to match all these costs up.
Bill, I think this gets to, if you waited on your forgiveness application, now there's strategy. Now there is some strategy now that you need to play out. First step would be, am I qualifying for the ERC?
Yep.
If I am qualifying for the ERC, now I've got to work hard to maximize my non-payroll so I can maximize my ERC. Do I have that right?
That's correct. Yep. And you'll see this kind of in the next couple of examples, right? So the next example, same thing, $100,000 loan, $200,000 payroll cost claim. You put it right on your application, $200,000 of payroll, but you also put the $40,000 of non-payroll, the rent, utility, so forth. Now they take a look at that and they say, well, you're deemed election because you claimed the $40,000 of non-payroll. We're only going to conclude that $60,000 of the payroll costs are not eligible for the employee retention credit. So, now you're on March 9th, you're talking to your advisor, and you're saying, hey, I think I'm eligible for the employee retention credit. Let me go back and do this. Well, your ability to maximize that employee retention credit has a lot of different factors in it. When were my eligible quarters? When was my PPP? What did I claim on my PPP? What did I submit my forgiveness application? And they state you cannot go back and amend a forgiveness application. So if you submitted it, it is what it is.
This is unfortunate timing here, but the government unfortunately has been doing this quite a bit in this whole process, and understanding that we're not blaming anybody and we don't think it's being done on purpose, but this is going to have an impact on people. There are some people that are just going to have gone through the maximizing of the PPP that are really going to look back and determine that they had some opportunities here that they're not going to get anymore because of this.
Yep.
It's disappointing.
Example 4, $100,000 PPP loan. You claim $75,000 of payroll and $25,000 of non-payroll. But you can go back and demonstrate that $50,000 of those payroll costs were not qualified wages. Now, I put this in my little asterisk there. I don't know if they mean that this is a timing opportunity or it's an other payroll cost opportunity. What I mean by that is that $50,000 that you can document are not qualified wages. Can you document that because you can demonstrate, and this goes into that timing and parallel spreadsheets, which I think that's where this is going, that you can document that was not paid at the same time frame, right? Like your employee retention credit was from March 12th until April 20th when you got your PPP loan, but you can document that's your $50,000, and then $25,000 are not, or is it saying, well, I can document that $50,000 were not qualified wages. They were healthcare and retirement and those other things that you could have gotten in your PPP. I think it's the former, but it's not 100% clear.
Hey, Bill, does this get to, and not to get too far into it, but some of the PPP concepts on forgiveness is, hey, you're qualified, or your period of use, and if 24 weeks, but you don't really need the 24 weeks. Yeah. But if you claim the 24 weeks, now you're pushing all of this payroll in it, but you only use half of it.
Right.
Is that now getting into example 4 where you've got $1 million of payroll, you only needed $500,000, but you used 24 weeks because you didn't really understand it? Is your $500,000 that's going towards your PPP, your qualified wages that can't be taken against the ERC, and then the $500,000 that you put on the application that didn't really apply because you didn't need them, are those still able to hit the ERC?
That's the way that.
That's all I'm reading.
That's what I believe. That's what I believe, Frank. And this kind of goes a little bit counter to what the I would say the common thought was that you have a PPP application, $100,000, you spent $250,000 on payroll from the date you got the loan to the end of the 24 weeks, you put the $250 there.
Yeah.
I think your question is saying, well, can I instead of that, can I just put $100 there because I wanted to make sure the first $150 is my ERC?
Well, I would now, based on this.
Absolutely.
I mean, but my point being is, if you already did it, if say you already went through your application process, you used 24 weeks on forgiveness, you only needed 10 weeks of payroll.
Right. Yep.
You now have another you have qualified or wages that didn't really go against PPP that you can now qualify for the ERC.
Yeah, right. And that's the whole point of this example. That's why I asked that question, is it timing? Because maybe you have an opportunity here where you could say, claim the employee retention credit, because the examples they always give are very nice and simple, and they all fit into a nice, easy fact pattern. But the reality is not that, right? And so, yeah, I got a loan for $100,000. I put $250 in there, and that covered me from April 20th to October 5th. But my eligible quarters were 2 and or quarter one and quarter two.
Yep.
Can I demonstrate that I can get to the 100,000, which I put in? I didn't put non-payroll in there. Can I demonstrate and say, well, my PPP really, I know I put 250 in there, but I only needed to cover 100, and I paid that between June 1st and October 5th. I think that's where I'd like to go with it. The guidance is 100% clear, but I think that's where I think that's what you got to do. That's the kind of thought process you kind of need to put through this. Let's go. This is going to take me too long to get through this. It's just an example showing, hey, let's it's just an example. Take a look at it, but it's just an example of how to maximize growth.
Yeah, we still have a number of people on the call, Bill. So let's get through the last couple of slides and see if anybody has questions, and then we'll wrap it up.
Okay. Claiming the employment retention credit for 2020, right? For most folks, that day is long and gone. You have to, in terms of filing it timely. So what you do is you have to file an amended 941X. 941 is your quarterly payroll tax return. It tracks, how much you paid to employees, how much you paid for, just general wages and comp, which may have deductions in there, right? People that are putting money into a 401k or, health plan or things of that nature. It reports your Medicare wages, your Social Security wages. It reports your deposits, right? Deposits you're making on your payroll taxes. It's generally filed by your payroll provider, ADP or Paychex or, any of the other ones that are out there. You're going to have to go back and amend that. So you contact your payroll provider if you have one and tell them I want to, I'm eligible for the credit. Here's my computation. And I want to go back and amend my Q2 my Q2 2020 941. And so that's how you're going to have to go about that process. 2021, there's we basically have three options. So right now Q1 is not due. That return is not due until I think April 20th or somewhere in that time frame. You can do a couple things. You can contact, if you're eligible in Q1, contact your payroll provider now and say, I want to reduce my payroll tax deposits. Now we only have, what do we got? 22 days left in the quarter, but that is an avenue that the IRS is allowing. Again, intent of the law, let's get cash into people's hands quicker. If you are eligible in Q1, you contact your payroll. They will probably have you sign a waiver, and then they will stop making those deposits that they pay every 2 weeks. They will stop making them. And that not only on the employer piece, which is this credit is for, but on your withholding, right? So every time you pay employee X, you're withholding, 30%, let's say, or 25%. They're going to allow you to keep that. All gets reconciled in the 941, but you can stop making deposits. Or you could actually do both. You can also file this Form 7200, which is in advance. You file that prior to the filing of the 941. That's the one-pager fax that I told you about earlier. All you're saying is I anticipate getting this much credit. There's probably about 15 lines that you need to fill out. And you fax that in, and you should get a check from the IRS in the amount of the credit. And then everything gets reconciled on your 941. If you didn't do the the deposit reduction or the 7200, you file your 941 timely. The credit will go on that return, and then you'd get a refund of the excess. You basically check a box saying I want a refund, and make sure your payroll provider does this. Payroll providers are, I know they have some. I know that they've basically put out some material on the employee retention credit recently, or some kind of systems that they put out, but I know that they rarely, if ever, will ever give tax advice. So all these other things we talked about, they're not going to advise you on that. And sometimes they miss things. I mean, they've got, it's a high volume business. So just make sure that if you inform them that it's getting onto your return, request a copy of it before it goes out. Look, there's a line item for the employee retention credit. Make sure it's going, and there's a line item requesting a refund. So make sure that box gets checked. Okay, go to the next one.
Okay, hey Bill, we're almost at 12:15, so we're gonna have to wrap it up. I have a couple questions that I want to try to get to too.
Okay, income and deductions, real quickly, just understand that this is a credit. It's going to get added back to income, and this is really important, well, for all businesses, but for partnerships and S corps especially, because the owners of those entities are probably giving themselves a guaranteed payment and or a wage if they're an S corp, and this is going to impact their ordinary income. And also a tip, if you are using a boutique firm, if they're doing a contingency fee, make sure they measure the value based on the net impact, because the credit, right? You got a credit of $100,000. That's going to get added. That means you can't take a deduction for the qualified wages in the amount of the credit, $100,000, which is going to increase your ordinary income. And it's going to have, depending on your tax bracket, it's going to have, potentially a 37% kind of add back. So the value is on the Fed side plus whatever your state taxes are. So in Connecticut, the max would be about 41.4%, but that's, pretty significant. POs, if you're using a PO, you are eligible for the credit. You do have to, you have to inform your PO of your intention to file the employment retention credit. And they will put it onto what they call a Schedule R on their 941, because they're filing a kind of an aggregate 941 for your company and many other companies. I would advise, 2020 is over and you can still go back and amend the 941, their 941, which has your common law employees on it. And so you're going to have to work with them in terms of timing, in terms of because I don't know if they're going to be filing amended 941s every time they get an ERC request, or whether they're going to wait for a specified period of time and then they're going to file them. Maybe they have some arrangement with the IRS, but definitely for 2021 versions of the credit, I would either file the advance now if you're eligible, and because all you need to do is put in their PO information. You can file that on your own, and then have them reconcile it when they're filing their return, or make sure that it gets on their timely file return so that there's no kind of amending of those returns that's required, because I think the amending return process with PO is going to be a mess. IRS audit, substantiation, it's all sitting right here. This is exactly what's in the notice. Shows you, what you need to have for your substantiation, which gets to Frank's point earlier. This is, I don't know what the audit cycle is going to be like this, but you
got to be ready.
There's a lot of money. What's that?
Got to be ready for the audit.
Got to be ready. Yep.
So listen, we've got a couple things. Which one should be applied first, PPP or ERC? I think what they mean is, do you have an order that's required for payroll costs to be applied into the PPP, then the ERC, or vice versa? I don't think there's a guidance there, is there, Bill?
So the way the law stands is that the kind of the default goes to the ERC unless you elect to put it towards PPP, and that election is done by filing it on your 941. So so the election, the election is not to do something, right? The election to put it as PPP is to not file your 941 with the ERC on it. If the question is just what takes precedent, if you had to do one or the other, PPP, because that's fully forgivable, and there's no add back to income and deductions and things of that nature. And so you definitely want to, if you had to choose one or the other, you want to go PPP. But ideally, you want to get both, and so that's where the timing comes into play.
Yeah, you got to that question has a lot of depth to it, and I think you should reach out to us or reach out to your advisor and work through the logic as to how to go through that application process. Bill, another question: how is the interaction influenced by a PPP1 loan forgiveness? Then you take the ERC for 8 weeks of Q1 and then get a PPP2 for Q2. It's a deep question there, Bill. It's a lot there.
Just repeat that again.
So how is the interaction influenced? So assuming you have a PPP1 loan,
yeah,
you have it forgiven.
Yeah.
Then you take the ERC for 8 weeks of Q1. I don't know.
Q1 20. Yeah.
I assume 21.
Q1 2021.
Yeah, I would assume, right? Because
okay. Yeah.
And then it doesn't say that. And then you get PPP2 for Q2 of 21.
Okay, actually, it's a great question, because I think it kind of gives it actually almost answers the prior question. So the fact that you got a PPP round one forgiven, it shouldn't have any impact on the 2021 version of the ERC. But you also got a round two PPP, and a lot of folks that I've spoken with that started coming in middle of February. Let's say that came in on February 15th. And actually, this was kind of the example I had in the thing. Let's say it comes in around February 15th, right? And you've got 10 employees and they all make anywhere between $40,000 and $80,000, right? What you want to do is you want to say, okay, well, I've got a loan for $100,000, right? PPP round two. I got 24 weeks to spend it. I only really need to spend $60,000 on payroll. I want to I want to direct money towards the employee retention credit in Q1 until I cap everybody out at $10,000, right? So the guy who's making 80,000, you're going to cap him out in about 6 weeks. The guy who's making 40,000, you're probably going to have to pay him for the full first quarter before you kind of cap him out. Take your employee retention credit, maximize that, right? Then now you're in Q2, you've got 24 weeks. You've got basically February 15th. You've got until when, like August 1st or somewhere in that time frame, September 1st. You've got it was August 1st. Then you've got a decent amount of time to continue to spend your PPP funds. Start spending the PPP funds on payroll after that period, right? After Q1's over, or after the period which you've maxed out your various employees is, so that you can maximize both benefits. If you end up being eligible in quarter 2, well, now you got to kind of do the same analysis as you go through Q2. Your payroll versus how much you need to spend on payroll for the PPP. And this gets to your point earlier, Frank, that you said, hey, I need to strategize. I mean, it's basically a game of chess, or, Bill Belichick in football. You need to kind of understand, like, where, when are the pressure points in terms of maximizing the ERC, but I have to make sure, again, to the last question, I got to make sure I maximize my PPP, because that's dollar for dollar, right? Dollar for dollar versus 70% with an add back to the tax effect. But you can do both. You just got to time it accordingly so that you can spend your money on payroll for the PPP, but also spend money on qualified wages for purpose of the employee retention credit. And then maximizing your non-payroll is critical. And I just want to make folks aware that as part of that December legislation in round 2, and they actually put it back retroactive to round 1. So if you haven't submitted your forgiveness application for round 1, there's new categories, right? It's not just rent and utilities. There's rent, utilities, there's supplier costs, right? That's probably a big one for a number of folks. There's operational software costs. So you want that $100,000 loan, when you submit that round 2 application for PPP forgiveness, you want to make sure you put $40,000, assuming you had the expenditures.
Yeah. Hey, Bill, it's funny, I was trying to interrupt you and you weren't letting me, and I realized I was on mute. Somebody asked if we had a listing of non-payroll related costs eligible for the PPP. I referenced them back to our many webinars on the PPP on our website. There's usually a pretty good summary there. And then if they have any other questions, to reach out to us and we can help answer those questions on the non-payroll related costs associated with PPP. So
yeah, they're going to want to check out the webinar, the one we did I think we did it in late December, early January, and then the one we did in later on in January, because that has the updated
list. Yep.
The updated the supplier costs and the operational costs. That was not part of the original PPP.
All right, Bill, we're almost, we got to wrap this up. I've got one additional question that I wanted to try to get to, but is there an end date on the use for the second PPP? Could we use the ERC first and then use the PPP in the third quarter of 2021?
It's a 24. So recall the round 2 PPP, you can do anything between 8 weeks and 24 weeks. So right. It all depends on when you got your loan, right? If you got your loan on the 15th of February, I think, if I'm doing my math correctly, I think that gets you to August 1st for 24 weeks.
But I think your point here, Bill, and I'm going to cut you off because we really do got to go, is you've got to do your math, right? You've got to do your strategizing on, if you've got your PPP loan issued on certain date in 21, do your math on the 24 weeks so that you can start strategizing where you want to put your buckets so you don't lose your forgiveness, PPP forgiveness, but you also try to maximize your ERC. Listen, this is great. Bill, as always, you kill it. I think everybody who stayed on for an extra 20 so minutes, appreciate it. We did have a number of people stay with us. We will get the webinar out. We will get the slides out. We really appreciate everyone's listening for so long, and we really do enjoy helping people through some of these complexities. Please do reach out to Bill, reach out to myself. The contact information is on the screen, and hopefully everyone has a great day. Bill, thanks again. We'll catch up soon. All right. Talk to you.
Thanks, guys.
All right. Bye now.